Welcome to the Motor Carriers Insurance Education Foundation, in-depth coverage addressing the unique operations of motor carrier series. Today's discussion will be understanding financial statements. If you have any questions, please send an email to trs@mcief.org and we'll answer those for you later and share those answers with everybody who's attended and post them on our website if they're of a generic nature. MCIEF receives a number of requests for information to better understand motor carriers and their financial position. When I received a request about financial statements, I thought of a friend, Dirk Nohre, who is a CPA. Our first meeting was in a CIC presentation concerning trucking over 30 years ago. Dirk, I think it was over 30 years ago. Was it not that we have been doing this?
Yeah. I'm sorry to say that it was, Tommy, and yes, but we're still here, so it's all good.
Right. So when I first saw him, because you got to realize he was a trucker CIC class in the CPA, I said, "What are you doing here?" And we have started a relationship since then through a lot of things. And Dirk has been not only a presenter at our annual conference, he had done programs before, but he's also been, for you all who don't understand, instrumental in helping us run the foundation, giving us a lot of expert advice about the proper way to set it up. And Dirk, the good thing about it is that because of your guidance and others, we are financially sound and are moving forward. And we really appreciate all you have done for the foundation.
You bet. You're welcome.
This is a little bit about him. Tell us a little bit about you and your firm and where you are in a cold country, but go ahead.
Sure. It's, I'm a CPA, and I started working for an insurance agency as a controller and chief financial officer many years ago, and was in the insurance business for a little over 10 years. And I think as a CPA, one of the things that happens, you get pigeonholed as being a bean counter or a number cruncher. And so in my work in the insurance industry, I really tried to become an expert in understanding the financial, accounting, and tax aspects of an agency. And so in that way, I developed some insurance expertise. And because so many agencies insure a lot of transportation industry clients, that's transitioned into doing a lot of work in the transportation industry as well. So when we started my CPA firm, we also focused on industries where we had some expertise, including transportation, including the insurance industry.
And you've worked actually for some wholesalers and helped done some broker deals of mergers and all, have you not? And those two, Dirk, as well?
Yeah, we do a lot of merger and acquisition work, appraisal work. I've taken an equity interest in some insurance firms during some different times. So I've been very involved in the insurance industry, even as I've owned my CPA firm, and done a lot of speaking at conventions and gotten to know a lot of agents very well and helped them with a lot of operational and financial issues.
That's great. Let's look at this. We're going to talk about the fleet underwriting, financial statement requirement. It depends on the size of the motor carrier and the risk. Dirk, a lot of our insurance carriers are requesting it if it's over 20 power units, if it's some kind of financial deals in those areas, different requirements. If required, again, we must get it for them. But we've had a lot of insurers who have pushed back a little bit. It says, I don't want to give it to you, meaning the agent. I guess they feel the agent, particularly small town agencies, might have some proprietary information in those areas. If that happens, cannot we have arrangement with the insured and or you as the provider of the information from the insured to send that directly to the insurance carriers? And is there a little protection by doing that as far as the insurance carrier then would have an obligation to keep all that information confidential?
Yeah, I'm not sure that it would be a legal obligation, but certainly if you provided that to the company with the understanding that that was just to be used for underwriting purposes, not to be shared with a local agent, I would think that most companies would honor that request.
So that'd be something if you have that pushback. But even if it's not required, what I hope you find in the time that we're going to spend here in this presentation, it could be a valuable asset or valuable information to look at those statements. It'll give you a lot of information about the insured and would help a better and more in-depth underwriting process. There's two types of statements here, Dirk. This is stuff on your area. How about you explaining these two kind of statements we have here on slide 8?
Sure. Most all accounting systems and all businesses, or most businesses, should keep two primary financial statements. Accounting is keeping track of all the financial activity in the business, and then when it's reported, it comes out under these statements. First of all, the balance sheet, which contains three of the types of accounts. It contains the asset accounts. Assets are items of value. Liability accounts, those are accounts which show the amounts that are owed to others. And then the difference between the assets and liabilities, the assets show everything they have, the liabilities show everything they owe. So the difference would be the amount of equity or net worth that the owner has in the business. Those three types of accounts are shown on the balance sheet, and they're often presented for the month or the year end that you're looking. And they're often compared to the prior month end or the prior year end or 1 year ago. And what I'd encourage the users to pay attention to is, yes, it's interesting to see a snapshot in time of the business, but looking at trends over a couple years or even longer to show whether the business is growing, whether they're shrinking, whether their profitability is increasing or decreasing, whether their asset balances are growing, whether their equity balances are growing, all very important to put today's snapshot in perspective of a longer term time frame.
We're going to look at them more with depth, but I want to also mention to you about this. Assets could be things that the insured would want to have coverage for, physical damage coverage on, like their tractors and trailers and equipment. And we're going to talk later about the difference in the value on the financial statement and the actual value of them, and that's what we're going to dig into. Liability can tell you, again, if they own the trade, if they have owner-operators, if they have debt on things. So, and the equity will obviously tell you what the company's worth. So even from that, Dirk, there are some insurance ramifications when we look at that, and we're going to look through depth. So that's the first statement. The second statement is the profit and loss. I hear a lot about that. Dirk, you want to mention those things too?
Sure. The first thing I'd say is that the income statement or profit and loss statement goes by several very common names, and this can be confusing to non-accountants. So anytime you see a statement with one of these names, income statement, profit and loss statement, P&L, it might be called the operating statement. They all refer to the statement that includes the revenues of the business, that is the source of funds, what they do for an activity, and then the expenses, how they're spending the money. So the revenues and expenses are included on what accountants will typically call the income statement. And then, of course, the difference between the revenues and expenses is either the net income or net loss. Typically, we would say whether the business is making or losing money would be found at the bottom of the income statement. A lot of times when users print out or look at the income statement, their eyes go directly to the bottom of the statement, just that bottom number, are they making or losing money? But with a little bit of knowledge, and what we hope to talk about today is there's so much more information on the income statement rather than just whether they're making or losing money. And even that question, whether they're making or losing money or the bottom line, can easily be, it's a very subjective number that can be influenced by different methodologies of accounting, what the owner is taking out of the business, a variety of things. So the bottom line on its own is really not quite enough information. And hopefully as we go through the revenues and expenses in a little more detail, you'll learn to see the other things that they should look at in conjunction with just the bottom line. The income statement is also presented. Go ahead, Tommy.
No, I'm sorry. I've often said they keep three types: one for tax purposes, one for the bank purposes, and one for the divorce court. So there could be different approaches for those.
Right. Unfortunately, the income statement, like the balance sheet, is often shown on a comparative basis. And what would be common and what we'd recommend is that the results for the month are showing compared with the results of the same month 1 year ago. So you can see the trend in the month. And then also the results for the year to date compared with the results for the year to date 1 year ago. So the income statement is often in a comparative format, and that is very important. And most accounting systems will show a comparative format, but a lot of times, depending on the sophistication of the business, they may print out a non-comparative statement because they really aren't even thinking about that. So when you request the statement, request a comparative format to see if it's available.
You also could look at the budget they have here, and the reason you might have to show a budget too, particularly in the income, so because a lot of times our policy would be based on what they expect to do in the future year, and that budget would show that that part of it too. So a lot of times they might have a budget too. Again, I imagine it would be how sophisticated our insured is that we're dealing with, and larger motor carriers would have those elements too. You also mentioned there could be a third statement, and this I've spend a minute on this because I think that's important too, because cash is the king.
Very important. And it's interesting, the balance sheet and income statement contain all of the accounts in the accounting system. So there's nothing that's not shown on the income statement or balance sheet. But a common question is, if you look at the income statement and say, well, I made a certain amount of money, then you look in the balance sheet, which includes the balance in the bank account. And if the cash balance isn't very good, but the income statement says they made a lot of money, the question is, if I made a lot of money, where is it? And the cash flow statement reconciles, its purpose is to reconcile the net income, which is the bottom line on the income statement, with the amount of cash that's on the balance sheet. And what you'll see on the cash flow statement, it's a methodology of reconciling those two. And what it'll do is it'll go to any non-cash items that are on the income statement, depreciation being the large one, and then also look at each of the balance sheet accounts to show how those balance sheet accounts, as they've grown or shrunk, how they've either consumed cash, used cash for things like equipment purchases or to pay down debt, or how they provided some cash where maybe the income statement isn't showing that it made very much money, and you're saying, well, how, or maybe that it's even lost money. Well, how is this business staying in business? Maybe they've obtained some loans. Maybe the owner has had to put in additional money. Maybe they're stretching their trade payables. So it shows why the cash balance has changed in relation to the income statement. It's a more sophisticated statement. It's a little bit more complex. So a lot of times only larger businesses or those that have a CPA prepare their financial statements, include it, but it answers a lot of important questions that business owners and others have.
I think one element here that we also overlook sometimes, and that's the profit distribution to the actual owners. In those cases, particularly a small motor carrier who's owned by a family or one or two people, I think it would be important then to also look into that ownership's equity. Would it not be to see if something happens in the company itself, they would be able to raise money to put back into the company?
Correct. And I think because when we get into the taxes, there are a lot of tax advantages in the ways that owners take money out of the business. And because an owner taking wages out of their own business is a very expensive way to take money from a tax perspective. And so a lot of CPAs advise the owners to keep their wages relatively low and then to take money out of the company through profit distributions. Well, those profit distributions, they are included in an account on the balance sheet. That might be counterintuitive, but when an owner draws money out of their business, it's included in an account in the equity section on the balance sheet, which sometimes is a little bit harder place to find that. So what I would suggest is, if you're looking at the financial statements and it shows that the business is making quite a bit of money, but you look on the balance sheet and it doesn't have very much money, then it would be prudent to look to see whether the owner is drawing money out of the business through what they call an owner distribution, a profit distribution, which would be included in the equity section of the balance sheet, or if they had a cash flow statement, there would be a single line item that would show that cash outflow as a profit distribution.
Thanks, Dirk. Now we look at various things. The in-house QuickBooks, I guess that's still the most common one. There are some internal systems and those things. You can set up QuickBooks to do everything we just talked about, could you not, in this area, and knowing what they're doing, and it's a pretty good product to look at but don't most of your, say, motor carriers with less than a couple $1 million worth of revenue use some kind of simple system like this?
They do, and QuickBooks would be one of the more popular ones. Sage is another popular program, and there are a number of others, but they're lower cost accounting systems. They do a variety of things. They're not specifically designed for the transportation industry, but for a smaller business, they work just fine. And what's interesting, as time has gone on, even these fairly inexpensive internal accounting packages like QuickBooks, like Sage, like others, they produce balance sheets, they produce income statements. There's quite a bit of flexibility in the formatting, so they can be formatted in ways that are specific to the transportation business. It takes a little bit of knowledge of the program. You can do comparative financial statements to compare against prior year end. You can put a budget in them. So it's true that sometimes when people have these lower end financial statements, when you look at them, they don't produce, sometimes they're not producing a really nice looking statement, but that's more about the ability of the user to format the statements than it is about the capability. And with really a fairly minor investment in professional fees, in the internal bookkeeper doing a little bit of work, they are certainly more than adequate to get you a nice looking financial statement.
And this is a good point for retail agents. I realize that there are a couple areas that we don't, as retail agents, want to do: practice law and practice accounting. But this is something that we at least could give some advice to the insurer to let them help them manage their own company there, and refer them to someone who can help them set those QuickBooks up, knowing that it is available. And so that would be a suggestion from a retail agent standpoint. If you run into a client who cannot produce what you're asking for, you might explain to him that this stuff is available and suggest that for not only our purposes, meaning insurance purposes, but his own company running purposes, he might want to do this. A lot of times, even in these cases, Dirk, I'm sure maybe not you as such as a CPA, but an accountant, but I have a lot of people. My CPA helps me with my QuickBooks as far as setting it up, and also that would be a low-end cost to you, since you don't get involved earlier than, say, maybe an annual tax return involved in that part of it. But this is outside help they might get, would they not?
They would, and most firms, including ours, we've got a QuickBooks Certified Pro on our staff because it's such a popular accounting program. And I think since a lot of transportation business owners, they're pretty thrifty when it comes to professional fees, sort of as a general rule. And so they, but when you explain to them that if they've got nice looking financial statements, look, if the insurance underwriter is looking at a nicer looking financial statements, they feel more comfortable about the way the business is being run. I think it can lead to more favorable treatment from the insurance carrier, and also with the bank and the other lenders, the leasing companies and others. When you see a nice looking financial statements that's properly formatted, the interest rates being charged on those equipment leases, on those equipment loans, on lines of credit, interest rates go down when lenders perceive less risk, and they perceive less risk when they have a nice looking financial statement. It doesn't have to be a CPA prepared statement that we'll talk about in a minute, an audited statement. Just a nice, properly formatted, comprehensive statement can lead to certainly lower cost of borrowing. When you explain it that way, the transportation owner might be a little bit more willing to put a little bit of money into investing in a nice looking financial statement.
And it'll also be able to show the difference between, as we pointed out, you're going to look into more detail later, the difference between cash and equity and loans to the officers and distribution, and explain in those things why that's done from a tax purposes versus actually, here's how I'm running my business. But we do CPA. I hear the three terms I get here all the time: compiled, reviewed, and audited. And that is up in there, and maybe you can go through those things. I don't see many auditable statements for risks of the size that typically we'll write, but as the far end. Talk about how those three are, and at least the differences of relying on those three.
Sure. When a CPA prepares a statement on behalf of the client or for the client, it's one of three levels of service. And the compiled statement would be the lowest level of service. You get a nice looking financial statement from the CPA. It's bound, it's professional looking, but it doesn't include any warranties or representations with regard to any kind of analysis that the CPA did. So it's less in cost, and it's less in terms of the representations or the assurance that are given. A reviewed statement is where a CPA, based on a prescribed level of procedures that the AICPA outlines, there's a number of technical analysis and analytics that the CPA firm does. They make sure that proper rules of accounting are followed. There's some technical analysis. So there's a certain level of assurance given. I'll call it a mid-level of assurance. And it makes banks feel more comfortable that there's some scrutiny given. Sometimes it makes the owner feel more comfortable when they've got a bookkeeping operation and they want to make sure that they can have some assurance the books are being kept correctly, et cetera. So mid-level of assurance. Then the audited level is where the CPA confirms all of the balance sheet items with the outside party. They confirm that the amount of money that they're showing in their bank account is really there, that the receivables are really owed by the outside parties, that the amount of liabilities that they're showing are accurate, all confirmed with the outside party. So obviously a higher level of assurance and a more time spent and a higher cost, but especially as businesses have to borrow larger and larger amounts of money, once you get to a certain level, banks will typically want an audit because they want a very high level of assurance, and that's typically where we see it.
So typically, it's not going to be involved in any of our businesses, or maybe if it's a publicly traded, and we got some insurance companies who might write those. But again, unless they're borrowing money, the best that I have seen for smaller motor carriers would be at least the reviewed one, Dirk. But most of them are just compiled, which is just a fancy way to say what we said earlier. The QuickBooks. I know you do more than that. I don't mean to simplify it, but the QuickBooks results put in the bound book. Is that not what it basically is the difference? Other than you have the accountant looking at it and putting in some areas.
Yes, that's true. But, accountants are very safety conscious. So even though they might not be required to do any due diligence to support the asset and liability balances, it's fairly common, even though there's no written assurance of it, it's common that the CPA will be asking the client for copies of the bank recs and some other support information. So even though it's not official assurance, there's certainly some scrutiny that most CPA firms would apply, and our firm does, and it would be fairly common.
And I find the most one it does is a lot of times things are miscategorized as far as what income is or expenses are. And when the internal bookkeepers and the company puts it in later, those things would be scrutinized by you or by my accountant and said, you should have put it in this line item versus that line item. So it would actually help out that way to make it a little better formatted. We talked earlier about taxes. Nobody likes to pay taxes, and so this is the elephant in the room about how do we do the tax and the difference in the tax return and the financial statements. I think this is something that's misunderstood, and maybe you can give us some clarification on these things.
Sure, and it's a complex topic, and we'll get into a variety of things, but of course, everybody has to file a tax return, so there are income tax returns, and those income tax returns will also include income statements. They all include an income statement because the net income or the taxable income is what you pay tax on. And when the entity files its own return, when the business itself is filing a return, then it also includes a balance sheet. Now, a lot of owners, when they're, when my clients come in, they just want to know where they sign and how much they owe. So they don't necessarily want to go through all the guts of the return, but there is also a balance sheet included in business tax returns. And so I'm just bringing up here that income tax returns include income statements and balance sheets, but the rules of what constitutes revenue recognition or expense recognition or balance sheet treatment can be different according to the tax laws than they are for the accounting reports, and that can get to be confusing. And so the people that are listening should understand that there are different accounting and tax rules that are governing the preparation of the income statement and balance sheets within the tax return. So we'll just start there at about a 30,000 foot level. One of the differences is what I'll call the basis of accounting or the accounting recognition rules. And a couple of terms are important here. One of the methods of accounting is called the cash method of accounting, where we don't record an entry in our books until the cash is either received or it's dispersed. If no cash changes hands, we don't make an entry in our books. That would be called the cash method of accounting, versus the accrual method of accounting, and that is when revenue is earned or an expense is incurred, then we make an entry in our books. For example, if we are hauling a load for a customer, even though they haven't paid us yet, that's a revenue producing activity, and we would make an entry in our books when we haul that load because we've earned the revenue even though they haven't paid us. And the same with an expense. Let's say that we have a driver has worked for us even though we haven't paid him yet. In a cash method of accounting, we wouldn't record that until the driver is paid. But in an accrual method, as soon as they haul the load, we owe them some money, and so we would make an entry in our books. That would be the accrual method. Separate or a combination of that is the IRS prescribes tax methods that are usually combination of cash and accrual methods, and based on the tax bill that is passed and whether we're in a strong economy or a weak economy, and Congress is trying to either goose the economy or they maybe feel that business owners are being treated too well, sometimes they're coming out with methodologies that are combinations of cash or accrual methods. So that's just a little high level of that.
Yeah, the one that I find here that also is one that's hard to get a grasp of is the credit card charges. Now that most of the stuff is put on a credit card, the expense has been incurred, the debt is due, but from a cash standpoint, you don't show it until 30 or 45 days later after it actually has become an expense. So those are the kind of things that you have to have the balance part of it. Let's talk about what insurance carriers are requiring, Dirk. A number of years to review. They're talking about 2 to 5 years. I think in these things, as from an insurance underwriter standpoint and an insurance carrier who's looking at their risk, it depends here. And this is where it's so important for what Dirk has mentioned here. This is what the underwriters look at. They're looking at trends, not only the snapshot of where we are today, but the trends. And are they growing or shrinking? Or cash growing or shrinking? Have they made some alternative movements from moving from own equipment to owner operators? These are the things they're looking at, and they're compared. So those are looking backwards the last 2 to 5 years. And then they want the most current year. And the difference, Dirk, what's your recommendation to doing a calendar year, meaning January to January versus a financial year from a business year?
In the old days, we'll say, it would be recommended that there was a seasonal trend in a business that businesses should end their business year or their fiscal year in conjunction with their natural cycle of their business. And so many businesses had year ends for business purposes that were other than December 31st. But with tax rules, since so many entities are organized as limited liability companies and S corporations, there are some limitations on what they can choose for a tax year end. And the IRS really encourages people to be and they incent people to be on calendar years. So since many businesses are now LLCs and S corporations, many of them have selected a calendar year for that purpose. So I would say that the calendar year is most common for a variety of reasons, including tax reasons. C corporations, those tend to be larger corporations. They are still allowed to have they can end their business year in any month they choose.
Dirk, I remember this, but I don't think the basic difference between C and S corp. S corp, the taxes flow back to the individual, where C corp, they have their own taxes and their own tax return, which makes sense as far as the end of the year, which is when your personal taxes are due, versus the company paying their own tax basis. Is that basically the difference between the C and the S?
Yes.
Okay. All right. And then you're making adjustments and reconciliations. These are things that where you have overestimated or underestimated. Is this the part of it too that needs to make those adjustments? But this is what the underwriters look at. We go back to the balance sheets again. We talked briefly about that starting up. So now we're talking about balance, access balance, items of value by that owned by the business. And again, the liability balance, this is the amount that's owed to others, and then the equity. The question I have here from an insurance standpoint is these assets, the items of value, that's what we end up later having to insure, is it not? And we have to worry about those things, because that could be the current property, equipment, and other things here. Obviously, cash and liquid assets is one of them. Do they meet their ongoing obligations? Is there enough cash coming on a periodic basis? And then you have the trade receivables. What is too old in the trade receivables in this area? And because I'm going to talk about later about what it takes, and going back to the cash to keep a truck on the highway in those areas, if you're having the receivable part, and if the shipper takes at least 45 days to pay it, going back to when you incurred the expense versus when you get paid for it, these age of receivables become two things that I think about. And maybe you can spend a minute to give us some insight on what we need to be looking at there, versus not only age, and after they're so old they might not be good, but also to look at the cash flow.
And I think there are a lot of transportation businesses have various models. They have different size customers. They have different hauling radiuses, things like that. And for each of those, there might be what I'll call an industry standard of when they should get paid for their receivables. And so as a business is growing, if they typically get paid in 45 days, then they've got their cash tied up in those receivables for that period. And if they're growing rapidly, then the receivables are growing. And so it takes some cash in order to fund the growth in a business, not just to buy more equipment if they've got their own equipment, but to fund their accounts receivable. And so when it's an exposure, and they've got to figure out the way to fund it in order to be a healthy business. Then you come up to a time where there's an economic downturn, or there's some challenge, or one of the customers gets in trouble, and then whatever the receivable is has some business exposure. So it just has to be managed properly. And then from an underwriter standpoint, you want to see, is this business operating like typical businesses do? Are they decent collectors, or are they poor collectors? Do they have responsible customers, or do they have irresponsible customers? And I think that goes to the risk assessment that an insurance firm would have to say, is this a well-run business, or is it not a well-run business? Does it have adequate cash flow or not? And you can start seeing the trends when you look at financial statements. Are they collecting faster? Are they collecting slower? Are they growing too fast, et cetera? Are some of those issues concerning receivables.
We'll have it a little bit later, but a typical truck should generate about $200,000 worth of revenue a year. And if you delay 45 days, that would mean that you'd have that much annually outstanding that part of the year. So you'd have that. And part of that is needed to keep the truck on the highway. Trucking has an immediate expense that cannot be delayed, from fuel cost and driver pay, and the cost of tolls and those kind of things. And Dirk, if you look at financial statement, that represents 56% of all the insured's expenses. So if they don't have about $10,000 or $12,000 free cash for every one of those trucks they have on the highway, or when they want to add a truck to the highway, my comment when I teach this face to face is ask the insured before they add that second truck, even owner operators trucks, do you have enough cash to ride out the receivables? But we also hear the factoring. I don't know how much you know about factoring, but that's actually just borrowing against your receivables. And the problem that I find in that, and maybe you have some experience I don't have in that, is that the trucker's margin of profit is so narrow that if they lack so much cash and have to factor the receivables, they're actually giving that factor company all the gravy they're making on the trucking operation. So I worry about them having to finance the receivables.
Yeah, I agree. And there's a couple of ways to finance receivables. As a business is stronger, it can go to the bank, and using those receivables as collateral, it can typically borrow money at a fairly competitive rate from a bank using the receivables as collateral. That wouldn't be factoring. That would just be, I'd call it a working capital line of credit, something like that. Factoring typically is when the receivables are sold to a lending institution, a factoring institution. They tend to be higher, excuse me, Tommy. They tend to be higher risk and higher cost. And so if a business isn't as prudent in managing its balance sheet and finds it's got some cash flow problems, then the cost of money with the factor starts eating into the profits, like you said, and it just is showing a little bit of a negative indicator about how well run and prudent this business is in terms of managing its cash flow. It presents a bit of a weakness.
So the point here is, if they are factoring their receivables, that's a negative, and you need to look more depth in there and find out why. And it might be because, as Dirk just suggested, they haven't managed their receivables well enough and are having to rely on either spending more money because they don't have enough capital reserve to ride through the receivable cycle, or having some bad collection habits, and so they factor those things off. You have the prepaid expenses. Those would be what, the 25% down on an insurance policy, on a reporting form, things like that. Dirk, would that not be the prepaid expenses that you pay now and over time that you would have to pay?
That's correct. That's correct. I'll point out one other thing, and that's a shareholder receivable, and that's usually buried someplace on the balance sheet. And what that reflects is sometimes the owner wants to take money out of the business, but the business hasn't really earned it yet, and so they start borrowing money from their own business. It shows as an asset, but it's really not, in most accountants' opinion. A lot of times it's not a very collectible asset. And it indicates that the owner may be living a little bit larger than they should because they're borrowing money out of their own business to live. And I think it just warrants, if you see a shareholder receivable growing and growing and it's always on the financial statements, it's never being paid off, it would be an indicator that the owner may be living a little larger than they should be out of the business.
So what we're talking about here, to balance what Dirk said earlier, the owner can take money out as a distribution. A distribution is money taking out, and that money is taken out and it's shown as a negative on the financial statement. On the financial statement, and it shows that would factor into the loss or the equity there. The shareholder loan, though, is the same thing. The owner gets it, but now that's still showing as an asset. So in that case, you have to worry about how much is collectible. Not going back to what we talked about, the distribution and or the loan, you need to find out, would the owner be able to put that money back in case of a problem, in case of a crisis here? And sometimes that's not happened. So that's where you want to be careful about looking at those two.
Correct.
Dirk, let's now look at the property and equipment. We own the tractors and trailers. And so what's put in there is a cost of what we paid for it, and that's the money we paid out. and now that's obligated to show as an asset here. But then what the motor carrier has a right to do is from that starting point to accumulate depreciation. You can talk about the difference in the years. That's for tax advantages, and that's the book, and it was showing the book as a value there. So how long can a truck? I've heard in some cases they can depreciate the whole thing for the 1 year for tax purposes. But there's a key in that, is there not?
That's correct, and it tends to be an area of some confusion. Typically the general rules of depreciation or buying fixed assets is when you buy a fixed asset, whatever you paid for it sits as an asset on your financial statements, and then it's assigned a useful life. And a lot of times with transportation equipment, 3 to 5 years would be a very common useful life. But just like the IRS has different methodologies for revenue recognition and expense recognition, at different times they will, trying to goose the economy, they will allow for tax methods, allow you to write off that equipment over very short periods of time. And so a lot of times, especially smaller transportation firms, they don't want to keep track of separate methodologies of depreciation. One useful life for keeping track of their books, and one useful life for keeping track of their tax return. And since tax returns typically will have faster allowable useful life or faster allowable depreciation, a lot of times small businesses will just use the tax methodology and start to write off their equipment very, very quickly, including writing it all off in the year of purchase. And what that leads to then is when you look at the balance sheet, if they're keeping their balance sheet on the same methodology as their tax return, you'll see that equipment being written off very, very quickly, and it understates the true value or the true useful life of that equipment. And so if you're the user of the financial statement, you'd want to ask, what methodology are you using to depreciate your equipment? And if it's a tax methodology, it's probably writing off the cost of the equipment faster than it's really being used in the business. I'm not sure if I did a good job of explaining that.
No, that's exactly right. But I found two things happen in this area. And the first off, when you ask the insured how much to insure that truck for, how much to insure that tractor for, it should never be based on what they have it on the books for, either purpose, tax purposes or other write-off, because that could have nothing to do with that, saving taxes. It's got to be what it's worth in real dollars to go out and sell it. If you had to sell it, or if it got lost, what it would take to replace it. That's the number that you want to use as your insurance part of it. It's also a way where you can see a motor carrier having not much equity in it, in the company, because they depreciated equipment and they have debt on that equipment, and the debt is more on it than what the book value is, but which is not a bad financial position as long as they're making enough income to pay that debt, Dirk. I see that happens also. So we got to look at the long-term obligations on that equipment and the long-term leases on that equipment to determine exactly what it's worth or not. So the other part of it is that if the number of trucks owned or not owned, this will be will show how many miles and what's revenue. So for every truck that's shown here, most insurance companies want to look at maybe somewhere around 100 to 105,000 miles on a truck that would generate the premium for those trucks, and on the revenue, again, about $220,000 a year. Also, if they don't have much own equipment, then they're also using own operators if it doesn't match those revenues in miles. So this is where you can, three things about it. Look at the value of the trucks, make sure and understand the difference in the tax or book value with depreciation, actually what it's worth and what it should be insured for, and look at the equity part of it. If the depreciation is quick, but the loan is on a 6-year loan, you might have more equity in the actual company itself than what's shown on the books. And you can also look at the measurement of how many owner operators they're using, depending on how much equipment they have, to generate the miles and the revenue that's shown.
Tommy, let me add one more thing there, if I could, and that would be our recommendation is Even for small transportation firms, we recommend that they keep their books, their QuickBooks, their Sage, whatever their financial statement package is, that they keep their internal books depreciating their transportation equipment on a straight line basis over a very reasonable, useful life, that they don't over depreciate it on their books. Then when they do their tax return, their accountant can easily take accelerated methods, very fast write-offs on the tax returns, and there's a little reconciliation schedule in the tax return where the accountant keeps track of that. In that way, just to your point, they have a better, it's a better reflection of the true value of the equipment, especially as it's measured against the debt that they still owe on it. And it's a fairly simple thing to do, and we recommend that they keep slower depreciation for books, faster depreciation for tax. They can have their cake and eat it too, and they're not constantly explaining to their bank or financial institution why their balance sheet looks weak because of some rapid tax depreciation.
This gets back to you have a balance sheet for tax purposes and for actual operation purposes. Forget the divorce court, but I recommend that too. I always drove me crazy back when I had my dealership and stuff. I said, look, I just want to know what the value of the truck is, or I don't need to know what the tax is. So we had co-seats here. I put something short in here, Dirk. I don't want to spend a lot of time on this, but if they own property, real buildings and contents, a strong recommendation to protect assets by putting that stuff in a separate legal entity, a trust or a family trust or something like that, part of it here. Because if they have those kind of investments in those things, now they're exposing everything that they own for a crash that might cost, everybody's heard about these nuclear verdicts and all that, that might cost everything they have. So to me, anything they own other than the trucks and trailers themselves, and even though they might want a mortgage or a leasing company, that they would want to try to move out to a separate legal entity. But if they do that, Dirk, there is some tax consequences on that possible, and they need to set it up by making sure it is managed properly. Because I find out what the court system sometimes challenge here is that if it's truly not arm's length, meaning separate bank accounts, separate phone numbers, and separate other things, or leases back and forth with each other, then that might be overturned. Could you, I'm sure you also
I can say that
recommend, go ahead.
Right. I could say we almost never recommend that a company own real estate in its operating company. It always has a separate entity, almost always a limited liability company for the liability issues, for the tax issues, for a variety of other things. They're simple to do, put it in a separate LLC. Yes, it's got to look like an arm's length transaction. There should be a separate lease, those kinds of things. But it's almost always recommended by the advisors to put that real estate in a separate entity.
And so the point here is there's two steps. You got to put in a separate entity, but you also got to make sure and help with your accountant to make sure it is a separate business, because the more commingling you have, the better chance later that would be a challenge later, a court case. Other assets, non-trucking investment, again, you don't want any of those things. You want to keep the trucking operation. There's so much exposure today with a trucking company and those trucks running down the highway and nuclear verdicts. The more you have all other real assets out of that company that are not needed actually to run those tractor trailers, the greater chance that your insured will be able to avoid a nuclear verdict, avoid being put out of business because of a claim. I also see goodwill. You might mention about goodwill, or there could be some other tangible things they're showing as an asset that really aren't worth anything. You want to spend a second on those?
Sure. When businesses buy other businesses, a lot of times the amount that they pay for that other business will be an amount that's higher than the fixed assets they buy, because they're also getting a phone number, some customers, some other infrastructure, something. And so what accountants' methodology is when you buy another business, whatever you paid for it that's over and above the amount of the tangible or hard assets, we book to an account called goodwill. And it's an intangible account. It is deductible for tax purposes, But when you say what's the value of that, it's not like you're going to go out in the street and sell that goodwill. So it's sort of a catch-all or a balancing account typically associated with buying other businesses.
And so actually those things you get as from an underwriting standpoint or looking at it, it's not a positive thing, even though it shows as an asset. It's just a way to write off the purchase price where you're buying more than the equipment you can depreciate. Liability, this Correct. Is the second part of it. This is amount owed to others. You got the current liability and long term. Debt on equipment, trucks. The current would be 12 months. And then long-term, it'd be over 12 months. Dirk, is that how you would book those things on the two sides?
Yep. I think when you look at a balance sheet, it is important to group the liabilities into those two sections. All amounts that are due within the next 12 months, which could be some short-term debt, lines of credit, amounts you have to pay the bank in the next 12 months, trade payables, accounts payable, payroll taxes, things like that. And then another section for long-term liabilities, those that are due more than 12 months from now, long-term equipment contracts, things like that. And one of the reasons that's important is users of financial statements will compare those current liability amounts to the amount of the current assets, because the assets are also grouped by assets that will be realized within the next 12 months in cash, which include cash, accounts receivable, those kinds of things, and long-term assets, which might be the property and equipment. So it's a very standard kind of allocation or grouping of liabilities and assets that outsiders would expect to see, and would be a minimum level of sophistication on an internal balance sheet.
And you also, going back to the value, you need to look at the debt on it versus the actual value and not the depreciated value. Do they have to also book lease obligations, Dirk, if there is a lease, kind of lease purchase obligation? Would that be also a liability they would have to show on equipment?
Yeah, that's a great question, and it's one where there's a lot of, not gray area, but it has to be looked at closely, because there are two types of leases. There are leases called operating leases, where the nature of the obligation is not like you're buying the piece of equipment. You think about renting a hotel room or renting an apartment for a month. You're not paying the full value. It's not a long-term thing. But if you enter into a lease agreement, we'll call these capital leases, where the lease obligation is fairly long-term, you pay the majority of the amount of the cost of that piece of equipment in lease payments, and at the end of the lease term, you can buy that equipment at that time for a bargain price, sometimes $1, sometimes a very low price. Then accountants want you to treat that lease, even though it's called a lease, treat it as if you purchased that piece of equipment. So they want the equipment, they want the asset on the balance sheet, they want the obligation on the balance sheet. And the accountants and the IRS have outlined rules for what falls within a capital lease versus an operating lease. But when it is a capital lease, it's got to be booked as if you purchased that equipment, even if it's called a lease.
If your insured owes money on equipment, you've got to make sure that on the policy or the finance agreement or the lease agreement that you have gap coverage. The gap is between what it's worth and what's owed on it. And it can be in the finance contract or the lease contract. The point here is, if it's a total loss, will the debt be paid off? The policy says we'll pay ACV, whatever it's worth, no more than the limit. Well, if it's worth less than what is owed on it, then you would not get it paid off at a total loss standpoint without having gap coverage. So that's a concern that you would want to look at to make sure. We talked earlier about a line of credit. This is a positive thing, and that can be done. And the advantage of the line of credit is you only get pay interest on it when you use it, for that purpose. But that's a backstop to being able to manage cash flow, is it not?
That's correct. Most businesses, especially those that are growing rapidly, because transportation can be a capital-intensive business, it doesn't make enough money on an after-tax basis sometimes to fund its growth in operations, its receivables, etc. And so it needs a what I'll call a working capital line or a line of credit to be able to support those accounts receivable costs or that investment as it grows. It's not a substitute for long-term borrowing. I'm not saying you buy your equipment using the line of credit. It's really for what I'll call cash flow purposes, but it's an important part of managing the balance sheet correctly.
You could also look at the debt to owner operators. If there's a large number of that, then you know that they're using some owner operators in those areas. You got the trade payables. You want those to be fairly current as far as when they're due, because what you book is the day they're due, not the day you pay it. Then we look at the debt on the property for the non-trucking things that when we look at the balance sheets to get a complete understanding of that. You have the tax liabilities. How do they accrue tax liabilities, and would you have to include a judgment on that, Dirk?
You know, it's interesting. Most smaller businesses are S corporations and limited liability companies, like we talked about, and the tax obligation is actually the owner's obligation. And so in those types of entities, you typically will not see accrued income tax on the balance sheet of the entity because it doesn't pay the tax itself. Instead, the owner pays the tax for it. And so you regularly won't see for tax liabilities. Judgments, you know, once there is a legal judgment, it would be proper accounting to record a liability for all amounts legally owed. I'm not saying that happens in practice all the time, but it should happen.
The other thing about tax liability, again, as you just mentioned from the float, this is where to pay those taxes, this is where the owner would take a distribution or even take a loan to pay those taxes if it showed that. So that's one reason, not only a legitimate reason, but a reason so they can pay the taxes, and that's how they'll take those out.
Equity, that's correct. It shouldn't be taken as a loan, though, because if the business made money, then it should have the cash to pay those taxes. And if it distributed the money to the owner, it should be recorded as a distribution, not that the money wouldn't be expected back from the owner. So it would just be a distribution.
Right, that's part of it. That's where they take it out. Equipment, asset minus liability, that's the investment, the invested capital you have. Those are the common stock. Paid in capital and those kind of things. Just a real quick overview. How do you look at those added things on the bottom of it just to show what company quote should be worth, but it's really not what it's worth?
Yeah, the point I'd make there is depending on the legal structure of the business, whether it's a C Corp, an S Corp, a limited liability company, a partnership, a sole proprietorship, each of those legal entities has different terminology for what it's called, what its equity is called. And that can be confusing. The only point I'd make is I think for users, it doesn't really matter what it's called, but the reason you see different terms in there is because the terms are linked to the form of organization that the business owner has chosen.
The other thing that we've included in this is retained earnings. That's the past profit they made versus the current year. And how does that, is there any difference to look at that and then the current ratios? Any value for the things that we list here?
Yeah, I would say a couple things. One, if you look at the retained earnings, that's the cumulative profit and loss. And if they've distributed some of those earnings to the owner, whether it's for taxes or for other reasons, it's the net earnings that were retained in the business. So if a business has been around for a while and you look, it should have retained earnings in the business. It should have an account called retained earnings. If it doesn't, then either the business hasn't been very profitable or the owner has distributed all those earnings to themselves. So that's something I would look at there. Another important ratio for the balance sheet is something we mentioned, the current ratio, which we look at the current assets versus the current liabilities to see, are there more current assets than liabilities to satisfy those liabilities when they need to be paid? That can be an important ratio. And then the amount of debt to equity. If you look at all the debt on the balance sheet to the amount of equity, a lot of times banks will they're looking to see how much money does the owner have at stake before they sort of default on their debt. And a lot of banks are comfortable with $2 of debt for every $1 of equity. sometimes even $3 of debt for $1 of equity. So just falling within those typical standard ratios would be one thing that a user would look at.
And it's tough for a trucking company to do that because they're not going to have 30 days worth of equity, a year's worth of cash in the bank to take care of those things. So that would be a tough time to balance those things. Then the statement shows a lot about the insured, their operation. Are they successful in business or not? The owners living within their means, ability to withstand business downturns, increase or decrease in leveraging, that's the borrowing here. And then there's concerns about the balance sheets to make sure that they're accurate and put things like that. And you got the revenue minus expenses, equity, that's the net income, or it could be a loss. Revenue and expense trends, increase or decreasing. Those are things that Dirk talks about, the trends. And, more or less, how effective is the business? Are they making money? And then we talk about the positive or negative cash flow. Dirk, early on, you mentioned the different tax ramifications, how the business is set up. You give us on this page the definitions. Run through this real quickly. Talk about how the profit flows and how the tax flows, depending on how it's set up.
Yep. There's the tax consequences of owning a business are a key criteria in deciding how a business should be organized from a legal perspective. And there are many different forms of organization, each have different pros and cons. I think the way I'd group them is to say that most of the forms of organization, including this top list, which would be the sole proprietorship, a partnership, a limited liability company, an S Corp, in those cases, the profits that the business makes flow through to the owner's tax return, and the owner pays tax on them personally, and then is able to draw money out of that business without paying additional tax in order to satisfy the tax obligation. That would be in comparison to a C corporation, which is a tax-paying entity on its own. Whatever money it makes, that legal entity is obligated to pay the tax when it files their return. I think the only reason I list all these here is that the terminology of these different entities, LLC, S corporation, sometimes there's different wording used in the accounts, in the tax returns look a little different. And I would just say at a high level, there are different reasons, different tax reasons for setting these up differently. That's really beyond the scope of this, but just for the users to be aware that there are different forms of organization that have different pros and cons. What I would say, though, is the owner of the business should know why they are the form of organization that they are, that to make sure that the pros and cons are appropriate for their situation. And of course, we always recommend that businesses be in a separate legal entity. We wouldn't recommend any transportation firm being a sole proprietor because there's no liability protection, or in a partnership where there's no liability protection. We would want them to be in an LLC or an S corporation, or I should say there's also limited partnerships that provide some liability protection. So liability protection is a very important aspect of this.
And from the insurance standpoint, to remind you here, the name insured on the policy, the liability policy particularly, should be the entities who owns these assets, that if a court case or a claim happens or a crash happens, that could lose those assets. That's who's got to be the legal entity on the name insured line. You don't want to put the owners, you don't want to put anybody else on that name insured line except the legal entity based on the setup of the corporation in those areas. Dirk, any other thoughts here other than you want to make sure they got enough cash to stay in business and they need to deal with a good accountant like you?
You know what I'd say is, and because this is my area, I feel like looking at the financial statements, you can tell a lot, not just about the success or failure of the business, but a lot about the character of the owner, because well done financial statements, I think, means that there's a certain level of competency, a certain level of character, and I think it's an important consideration in assessing the risk of a transportation business.
Yeah, and the better they have, the better they're managing their company. So many people forget how to manage a company, and that's one of the flaws, particularly with somebody who's a new venture. They don't go in and they don't properly account for their business, and unless they get a monthly accounting of how they're doing and comparing the trends and those, that kind of stuff, they're going to have a difficult time. And so underwriters and retail agents, we hope that going through this, you can now have a better understanding how to look at your insured setup and how to look at the cash flow and the need to stay in business and be able to review it properly. With that said, Dirk, I really thank you for sharing this information with us and with the members of the foundation. And again, if you all have any questions, please send us an email at trs@mcief.org. Dirk, thank you, my friend. I really appreciate it.
Yep. You're welcome. Thanks again, Tommy.